In this rematch, we are going to once again pit Canada's big three telecoms in a cage match, and there can only be, well, one winner. Hold on to your seatbelts, folks. This is going to be a good one. This is a requested deep dive rematch between TELUS, Rogers, and BCE or Bell. In this battle, we will be pouring through the fundamentals and assessing which of these blue chip giants has the edge. Canada's telecommunication sector is a dynamic and competitive market that is ruled over by those big three. There are other players for sure, but most are owned by the big three or are not on a national stage. Quebecor, with their purchase of Freedom Mobile, could one day challenge the status quo, but they are yet to make that impact. We have done this battle before, as in last January, but things change, and the winner in January may have a tough time defending their title. In fact, in that battle, Rogers narrowly beat out TELUS for the title, and perhaps TELUS has something to prove this time, or maybe the underdog BCE may just have a story of their own. Join the conversation. Let us know in the comments if you hold any of Canada's big three in your portfolio. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. With three companies, we have a lot of math for this one, so we are not going to waste too much time with preamble. In fact, I think we will just get to it and call on our good old buddy, Mr. Math. Round one of this battle will be our surface data. We're going to start off with Bell. They have a market cap of $36.04 billion, a very stable beta of 0.52, and their earnings per share come in at 1.77. Their price to earnings ratio, that comes in at 22.32, and they've got a return on equity of 11.10%. Let's take a look now at TELUS. With TELUS, we have a market cap of $35.39 billion, another stable beta of 0.68. Their earnings per share a little bit lower at 0.58, and they have a price to earnings ratio of 45.04. That return on equity, that comes in at a pretty low 4.65%. And finally, in round one, we have Rogers. Their market cap, that comes in at $30.62 billion. They've got, once again, a pretty non-volatile beta of 0.47. Their earnings per share looks pretty respectable at 2.01. Their price to earnings ratio, that comes in at 28.86, and they have a return on equity of 9.98%. Round one does not hold as much weight as the other three rounds, as it is only the surface data. They have similar market caps, and their betas all look fine. TELUS is a little bit lower on the EPS and a little high on the price to earnings ratio, but not enough to really be concerned with. Round one, though, it's going to go to BCE, with Rogers in a close second and TELUS bringing up the rear. Let's move into round two. For round two, we are going to look at the cash and, of course, their fair value. We'll start once again with BCE or Bell. They have a revenue of $24.64 billion. Their earnings come in at $2.22 billion, and those earnings are projected to grow by 10.05% per year over the next 5 years. Their profit margin comes in at 9.0%. When we look at their fair value, they're actually undervalued. They're priced 60.6% beneath their fair value. Let's switch on over and take a look at TELUS now. With TELUS, they have a revenue of $19.87 billion. Their earnings come in at $801 million. Those projected earnings, though, are supposed to grow by 28.86% per year. Holy banana bread, that's not too shabby. They have a profit margin a little bit on the lower side, 4%, and they are priced at 57.6% under their fair value. All right, we'll switch over now to Rogers. Rogers has a revenue of $18.14 billion. Their earnings come in at $1.03 billion, and their projected earnings are supposed to grow by 26.87% per year. That's not too shabby. They have a profit margin of 5.7%, and when it comes to fair value, they are currently priced at 27.5% under that. When it comes to cash, BCE really dominated in all stats, except for projected earnings. Bell won this round without contention. Very close when it comes to second, but I think Rogers eked out ahead of TELUS. So far, BCE is well ahead after the first two rounds. However, with 2 rounds left, there is still a chance for Rogers or even TELUS to still win the day. Let's move into the third round and check in on the dividends and returns. We will start once again with Bell. They have a dividend yield of 7.157%. It's a quarterly dividend paid out in the amount of 96.8 cents per share. Their payout ratio comes in at 156.66%. When we look at their 3-year total return, that comes in at 14.70%, and their year-to-date total return comes in at negative 3.56%. Let's take a look at Rogers. Rogers. Rogers has a much smaller yield of 3.478%. That is, once again, a quarterly dividend of 50 cents per share. Their payout ratio comes in at 99.50%. Their 3-year total return, that comes in at 12.95%. And their year-to-date total return comes in at negative 2.05%. Finally, we have Telus. Telus has a yield of 5.998%. That's quarterly dividend, 37.6 cents per share. Their payout ratio comes in at a huge 264.70%. They have a 3-year total return of 2.90%, and their year-to-date total return comes in at negative 4.10%. Round 3 is going to go to Rogers. They have the best year-to-date return, and their dividend is the most sustainable. Bell has a really nice dividend and was not that far behind, so they take a close second in this round. Telus once again comes in last place. Overall, after 3 rounds, this is still Bell's match, and Telus may need a miracle to pull out a victory at this point. However, that final debt round is huge, so let's jump right into it. And for the last time, we will start with BCE. They have a total debt of $34.70 billion, and their total equities add up to $21.31 billion. That's a debt-to-equity ratio of 162.9%. They also have some cash and cash equivalents of $619 million. When we look at Telus, their total debt a little bit lower at $25.48 billion. They've got total equities at $17.51 billion. That gives us a debt-to-equity ratio of 145.6%. They've also got, in cash and cash equivalents, $1.21 billion sitting around, so that's not too shabby. Let's look at Rogers. Rogers has a total debt of $45.94 billion. Their total equities only come in at $10.97 billion. That gives us a pretty scary-looking debt-to-equity ratio of 418.9%. Mind you, before they took on all that debt to buy Shaw, that ratio was still pretty high at 193.3%. Now, when it comes to cash and cash equivalents, they do have $2.53 billion sitting around. The final round, hands down, goes to Telus, as they have the best debt situation. In second place for this round is Bell, and in last place is Rogers. And I do think once they recover from the debt they took on to buy Shaw, these numbers may look better next year, when I'm certain I will have a request for yet another rematch. So who is the winner of this telecom cage match? Sometimes the underdog wins, and that is what happened today, with BCE taking the title away from Rogers. Right out of the gate, Bell pushed ahead with the surface data and kept the momentum going into the cash. They did falter a wee bit on the last 2 rounds, but only by a little, and still came in second on each of these rounds. They came close on the returns round, as they do have that amazing dividend that will appeal to the passive income investor. With Bell taking the crown, the runner-up then goes to Rogers, as they were strong in most categories, though they did fall big time on the debt, which helped Bell secure their victory. Telus came in last, which seems bad, but nonetheless, I still do kind of like Telus overall. Long term, I think you can't really go wrong with any of the 3, as they are all blue chip and are very stable overall. You can make arguments for any one of these telecoms and be completely justified in adding any one of these to your portfolio. As usual, if you are interested in any of these telecom stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on 100% growth stocks, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.